Welcome to the Real Estate Channel. Are you looking to sell your investment property and upgrade to a bigger or better one? Without losing a large chunk of your profits to taxes? Well, if so, you might want to consider a 1031 exchange. In this video, we're going to dive into the ins and outs of this tax deferment strategy and show you how it can help you save money, so you can grow your real estate portfolio. So sit back, relax, and let's explore the world of 1031 exchanges together. A 1031 exchange, also known as a like-kind exchange, is a powerful tax strategy that allows real estate investors to defer paying capital gains taxes on the sale of an investment property. The name 1031 comes from the section of the IRS tax code that outlines the rules and regulations for this type of capital gains tax deferred exchange. In order to qualify for a 1031 exchange, both the property being sold and the property being purchased must meet certain criteria, and the transaction must follow specific timelines and procedures. The strategy involves the sale of one property and the simultaneous purchase of another like-kind property. As long as the guidelines and timelines outlined by the IRS are met, the profits from the sale of the first property can be rolled over and used to purchase the new property without incurring capital gains taxes. The main purpose of a 1031 exchange is to allow investors to reinvest their profits into new properties, rather than paying taxes on those profits and potentially reducing the amount of money available for new investments. This can help investors to grow their portfolios and achieve their financial goals more quickly. To qualify for a 1031 exchange, the properties involved must be used for business or investment purposes. This means that a primary residence cannot be exchanged under the 1031 rules. Additionally, the properties must be of like kind, which means that they must be similar in nature or character, even if they are not identical. For example, a rental property can be exchanged for a commercial property, or a piece of raw land can be exchanged for a developed piece of land. The process of a 1031 exchange begins with the sale of the relinquished property. The proceeds from the sale are then held by a qualified intermediary, also known as an accommodator, who is responsible for ensuring that the exchange complies with the IRS rules. The investor then has 45 days from the date of the sale of the relinquished property to identify potential replacement properties, and 180 days from the date of the sale to complete the purchase of the replacement property. It is important to note that the 1031 exchange rules are complex, and it is highly recommended that investors work with a qualified tax professional or attorney to ensure that the exchange is done correctly and in compliance with the IRS guidelines. To recap, here are the key points to keep in mind when it comes to 1031 exchanges. A 1031 exchange allows real estate investors to defer paying capital gains taxes on the profits from the sale of an investment property by using the proceeds to purchase another similar property. To qualify for a 1031 exchange, the property being sold and the property being purchased must be like-kind, meaning they are similar in nature, character, and use. There are strict timelines associated with a 1031 exchange, including a 45-day identification period and a 180-day exchange period. It's important to work with a qualified, trusted intermediary and follow these timelines closely to ensure a successful exchange. There is no limit to the number of times an investor can use a 1031 exchange to defer taxes on investment properties, as long as the properties being sold and purchased meet the like-kind criteria and the timelines are followed. To fully defer all taxes, the value of the replacement property must be equal to or greater than the net sales price of the property being sold, and any mortgage debt on the replacement property must be equal to or greater than the debt on the property being sold. Real estate is all about strategy, knowledge, and a little bit of creativity. So, keep exploring, keep learning, and keep growing your real estate empire. Remember, as long as the guidelines and timelines outlined by the IRS are met, a 1031 exchange is a powerful tax strategy that can help you to grow your real estate portfolio and achieve your financial goals more quickly. As always, be sure to consult with a qualified tax professional or attorney before embarking on any real estate investment strategy. Thank you for watching this video on the basics of a successful tax-deferred 1031 exchange. We hope that you found the information to be helpful and informative. The information in this video is for educational purposes only. Nothing in this video should be interpreted as financial advice. We strongly recommend consulting with qualified tax professionals with any tax-related questions you may have. We value your feedback and comments. Please feel free to leave them in the comments section below. Don't forget to like and subscribe for more real estate insights, and I'll see you in the next video.